by many analysts as the next big thing, but the boom has failed to materialise. Last year, foreign investors bailed out of the country's equity market, kept at bay by a weakening currency and sky-high inflation. But it looks like they are coming back in. So far this year, the benchmark VN index has rallied over 12%, and our guest thinks over the next 24 months, Vietnam could offer investors 120% upside. Let's find out more. David Rose, Chief Executive Officer at ASEAN Investment Management, joins Adam and I now live from the Singapore Exchange. 120% over 2 years, David. Those are some impressive numbers.
Well, yes, impressive. And from the typical investment stance, I think many people don't like to talk about numbers like that, but I was asked the question on a relative value basis, looking around the region in ASEAN markets, where is the most compelling value? It's in Vietnam. If you're looking, at the region as a whole as being a beneficiary in the medium term of, let's say, the events that are going on in the slowdown in the developed markets, you could look at places like Singapore or Thailand or Indonesia, which have been over the last few years the beneficiaries of a lot of the investment, and you could say they could potentially perform 20 to 35%, let's say, over that same time period. But on a relative basis, if you were to see a revaluation of comparable companies across those markets, those are the kind of numbers that you could easily see out of Vietnam.
Okay, let's delve into this market a little bit further and talk about why you're expecting to see such strong investment returns, David, because clearly there are a number of issues that still dog the country. There are a number of risks, and one of which, and the main one in fact, being the level of inflation, still double digits, and of course the currency as well, the dong.
Yes. If you look at if you freeze it and you look at the numbers aren't, attractive from just a straight number or level perspective. But if you look at the trend and you look at what's happened, inflation is coming down. It's coming down significantly. Following that and already implemented by government policy, you're seeing bank deposit rates coming down. Those two factors alone are clear indicators for future equity outperformance. If you look, again, historically what's happened in other markets which have had, let's say during the Asian financial crisis in '98, you had countries, Indonesia, Thailand, which had huge amounts of, or very high levels of inflation and very high levels of bank deposit rates similar to where Vietnam is coming out of. And you took a look at where those markets, how they've performed. They've also done similar outperformance levels, what we're indicating for Vietnam.
David, I've been watching this market with a lot of curiosity over the past 8 months or so. And we've had a few guests talking about it, but it was interesting in a very difficult backdrop last year. And I want to get your take on this before we kick off with what you're looking at individually and sector-wise. Back in August, when global markets were rather maligned, the Vietnam index moved from about 380 over the course of 30 days to about 470, and then there was this deep plunge. What was the reason for that move, and fundamentally, have we seen the conditions change between then and now to be so bullish?
Well, you point out a very interesting thing in terms of the volatility of the move. And again, we are talking about emerging markets, and volatility is something that we accept as investors in those markets. But when you talk about numbers like 100% moves, the point is that they can happen in a relatively short period of time. In other words, in less than, and I'm not talking about the index necessarily. The index is of course the top line tickers. It's also the companies that are the largest companies, and they typically won't move as fast as some of the companies that we invest in. But to have a 100% move in 30 trading days is not unreasonable, right?
Sure. Okay. Well, that said, I mean, you're talking about supernormal returns over the course of 36 months. From an investor, is it as easy as just picking a whole basket of stocks, or do you need to be more selective?
I think at this stage, you need to be careful, of course, in terms of what stocks you choose, because the supernormal returns that are available are in the range of 300%. If the index moves 100%, individual stocks will move 300% plus. Okay, so, but you can, again, traditional concept of diversification can limit some of that risk if you don't have the capacity to fully understand, a specific company risk. And at this stage, sector selection is much less important, or specific company selection is much less important than allocating assets to the country as a whole, and of course having a diversified basket which meets, let's say we would look at a particular theme. You may want interest rate sensitive stocks or just extreme value stocks, which are two themes that we look at there, right? So interest rate sensitive, of course, banks, brokerage companies, those companies, you could say, well, the banking sector has recently been rated the lowest, okay? You've got moves by government to force some banks to consolidate. There are clearly non-performing loan issues, but when interest rates come down, and equity prices or other asset prices rise, some of those non-performance issues disappear, and they disappear relatively quickly. So banks and brokerages or real estate developers who are highly interest rate sensitive will be also the upfront initial beneficiaries of a reduction in interest rates and a reduction in inflation.
David, give us an example of your extreme value stocks here, because you're talking about your classic Triple Crown, deep value, high growth and high dividend yield, and you're saying that this can be found across a multiple of sectors. Yes. On the Vietnam market. Give us some examples.
In terms of examples in sector, let's say a cement company, which would have all of those characteristics, a PE of around 3 times. You'd have growth rates in excess of 20%. At the same time, a trailing dividend yield of more than 20%. So whenever you find that combination where you've got value, you've got growth, and you've got current income, it's usually a very good investment to make. The question here is it the right investment to make, or is Vietnam the right place to make that investment? And when you've got a company that is like a cement company, which many would look at as a very, it's a basic industry. So that type of investment it's an easy choice. It's an easy decision to make. But you will find samples of that across manufacturing industries. You'll find it in food industries. You'll find it in some let's say, commodity production industries. So it's at the moment is quite widespread, and that's the fundamental reason why, if you're a value investor and you're willing to look at emerging markets and take emerging market risk, why Vietnam at this stage is compelling, particularly if you're comparing it to, let's say, Indonesia or Thailand, which are at this stage, although their future prospects are still good, they're fairly valued, and if you do have a pullback, those markets in particular are subject potentially to a correction.
Okay. All right, some interesting thoughts there, David. We do appreciate your time. Thanks for chatting to Adam and I.